from Lilu's investment in Lukoil, a deep dive into a value play. Part 6. The Math That Mattered. Cents per barrel versus reality. This is where the whole thing collapses into one number. Not a model, not a narrative, a ratio. Lilu doesn't ask what Lukoil will earn next year. He doesn't care about 5-year forecasts or terminal values. In this environment, those are fake precision. He asks a simpler question. What am I paying per barrel of oil in the ground? That's it. Because oil is already priced by the world, every day, in dollars, with brutal transparency. At the time, oil is trading around $20 a barrel. That's the reality price, the price at which buyers and sellers around the globe agree oil is worth today. Now he looks at Lukoil's implied valuation through the voucher system and early trading. The core of Lilu's thesis was a quantitative comparison that revealed a pricing disparity so extreme it rendered standard valuation models irrelevant. In his lectures at Columbia Business School, Lilu has repeatedly cited the cents per barrel metric as the primary heuristic for this investment. In the early 1990s, the global price of crude oil fluctuated between $15 and $20 per barrel. Western oil companies were typically valued by the equity market at approximately $5.00 to $13.00 per barrel of proven reserves. This valuation reflected the market's confidence in their ability to extract, refine, and sell that oil at a profit, as well as the safety of their property rights. In contrast, during the voucher privatization and the immediate post-privatization period from 1993 to 1995, Russian oil companies like Lukoil traded at implied valuations of 5 cents to 20 cents per barrel of proven reserves. This is what's shown in the table. This table compares how oil and gas reserves were valued in the early to mid-1990s across Russian producers and Western supermajors, highlighting an extreme valuation gap. Despite Lukoil holding reserves comparable to Exxon and Royal Dutch Shell, 10 to 15 billion barrels, it traded at just 1 cent 20 cents per barrel versus $8, $13 per barrel in the US and Europe, implying a market cap of only approximately 50 cents, $2 billion compared to approximately $80, $100 billion for Western peers. Gazprom was even more deeply discounted, often trading at fractions of a cent per barrel of oil equivalent due to state control and gas-heavy reserves. The table illustrates the core anomaly Lilu exploited. Identical physical assets priced orders of magnitude apart, squarely fitting a Benjamin Graham balance sheet, deep value framework where assets traded far below liquidation value. This table quantifies the extreme scale of the mispricing machine by comparing Russian energy giants to their Western peers during the 1993-1995 privatization window. It shows that, while companies like Lukoil and Exxon possessed roughly similar physical oil reserves, 15 billion barrels, the market valued them at vastly different levels. Western markets priced Exxon's oil at $8.00 to $13.00 per barrel, whereas the chaotic Russian voucher market priced Lukoil's oil at mere pennies, 1 cent 20 cents, and Gazprom's massive reserves at fractions of a cent. This discrepancy reveals that Russian industrial assets were effectively sold for roughly 1% of their global fair market value, creating a massive arbitrage opportunity for the few insiders who recognized that the vodka valuation of these vouchers would eventually align with global reality. Lilu recalled the math vividly in his Columbia lecture that he gave. The 5-year average for oil prices was about $20 per barrel, and on a per-share basis, they were trading for as low as 1 cent on the dollar. So, about 10 cents to 20 cents per barrel of crude oil. This valuation falls squarely into the Benjamin Graham methodology of buying assets below their liquidation value. Lilu explicitly described his approach at this time as looking for value primarily on the balance sheet in the classic style of Benjamin Graham, looking for a cigarette butt. The logic was as follows. Intrinsic value floor. Even if the Russian economy remained dysfunctional, the oil itself had a global market value. If Lukoil could export even a fraction of its reserves, the cash flow would dwarf the entry price. The asset was dollar-denominated, global oil price, while the equity was ruble-denominated, local chaos. Asset protection. In a scenario of hyperinflation, hard assets, oil, retain value, while currency debases. Buying oil reserves for pennies was effectively an inflation hedge. Margin of safety: at 10 cents per barrel, the price could drop 50% or 80%, and the thesis would not break because the underlying asset was worth 50x or 100x the purchase price. The gap between price and value was so vast that it absorbed almost any operational error or external shock. Even if oil prices dropped to $10/barrel, which they did in 1998, the spread between the 10 cents valuation and the $10.00 commodity price was still 100. 1. The break-even for the investment required an apocalypse that destroyed the utility of oil itself, not just a recession. This is the essence of a deep margin of safety. Lilu held the position through the mid to late 90s. This period saw a massive run-up in asset prices. The Russian stock market was the best-performing market in the world in 1996 and 1997, driven by the re-election of Boris Yeltsin, defeating the communist candidate Zyuganov, and the influx of foreign portfolio investment. By 1997, Lukoil's market capitalization had surged. The stock, which might have been acquired at a split-adjusted equivalent of pennies, was trading at significantly higher multiples as the Russian boom took hold. The RTS index went from 100 in 1995 to nearly 600 in late 1997. And the answer comes back insane. The market is valuing Lukoil's reserves at something like 10 to 20 cents per barrel. In some cases, even lower. Read that again. 10 cents versus $20. This isn't a rounding error. This isn't optimism versus pessimism. This is a 2 orders of magnitude disconnect. It means you're buying oil at about 1% of its global price, sometimes 0.5%. At that point, almost nothing else matters. Political risk? Okay, discount it. Corruption? Discount it. Inefficiency? Discount it. Even theft? Fine. Discount it too. You can be wrong about a lot and still make money when the gap is this wide. That's what margin of safety actually means in practice. Not a vague feeling of comfort, but arithmetic that forgives error. Here's the key insight. This price is not saying oil is worth 10 cents. It's saying sellers don't care what oil is worth. They care about cash today. So the market price isn't a judgment on the asset. It's a reflection of human urgency. And Lilu understands that urgency expires. People calm down. Systems stabilize. Time passes. Assets reassert their utility. When that happens, prices don't need to go to fair value for the investment to work. They just need to stop being insane. If 10 cents becomes $1, that's a 10-bagger. If it becomes $2, that's 20. You don't need perfection. You need normalization. And here's the subtle part. Oil companies are leveraged to normalization. Once the panic fades, the valuation framework changes. Investors stop asking, will this survive, and start asking, what is this worth? That shift alone reprices the asset dramatically. So Lilu isn't forecasting oil prices. He's arbitraging valuation frameworks. He's buying in a world where assets are priced like scrap and holding until they're priced like businesses again. That's why this trade works even through disaster. Later, when Russia defaults and the currency collapses, people are shocked by how well early buyers still do. But they shouldn't be. If you bought oil at 1% of value, a 90% currency collapse doesn't kill you. The math already did the work. This is the kind of investing most people never get to do. Not because it's complex, but because it requires sitting inside a number that looks too stupid to be real. Cents per barrel. That was the signal. Everything else was noise. This is Avi. Like and subscribe. On to the next.